turn on the news or scroll through social media, and you're almost certainly guaranteed to hear a politician say something like this. Our country has a massive trade deficit. We're losing. Other countries are taking advantage of us.
We have a big deficit with them. They sell millions and millions of cars, as you know, Mercedes and BMW and Volkswagen and many others. And we were restricted from, essentially restricted from selling cars into the European Union, which is not nice. And I just said, it's time that we play the game the way I know how to play the game. You know, they've taken advantage of other people representing this country, and they're not going to do that any longer.
That number, the trade deficit, is one of the most misunderstood figures in economics. It sounds like the country is bleeding money, like a business that's billions of dollars in the red. But what's actually happening? Does that money just disappear? The short answer is no. The dollars we spend abroad for imports don't vanish. They come back to us in other forms, like foreign investment in U.S. companies, in stocks, real estate, or government bonds. To understand how all of this fits together, we need to look at a country's balance of payments, a kind of economic scorecard that tracks all financial flows into and out of a country. So in this video, we're going to learn how to read that scorecard so you can look past the headlines and understand the full picture of how a country interacts with the global economy. So let's start with the basics. What exactly is balance of trade? The balance of trade is simply the difference between the value of a country's exports and imports over a given period of time, usually a year. While it can include services, the most commonly cited numbers focus only on goods, physical items like cars, electronics, oil, and agricultural products. Services like tourism, banking, education, or software licensing are often tracked separately or folded into a broader category we call the current accounts, which we'll talk about in just a moment. If a country exports more than it imports, it's said to have a trade surplus. It's running a positive balance of trade. Conversely, if it imports more than it exports, it has a trade deficit. It's running a negative balance of trade. Let's look at the U.S.-China trade as an example. In 2024, the United States exported $147.8 billion worth of goods to China, including agricultural products like soybeans, advanced technologies like semiconductors and their components, and industrial goods like civilian aircraft and engines. In the same year, the United States imported $427.2 billion in goods from China, dominated by consumer electronics like cell phones and computers, along with apparel, toys, and furniture. The gap between imports and exports resulted in a goods trade deficit for the United States of $279.4 billion, highlighting one of the most politically significant trade imbalances in the global economy. This sounds pretty straightforward, but here's where it gets tricky. In public debates, trade deficits are often framed as a sign of a national failure, as if the country is losing a game or bleeding money. But a trade deficit is not necessarily a bad thing. It might reflect strong domestic demand or a strong currency that makes imports cheaper. It might also mean that consumers have access to more choices and lower prices for imported goods. Likewise, a trade surplus isn't automatically good. It might mean that the country is producing a lot, but it could also reflect a weak domestic level of consumption or a reliance on export-led growth that creates vulnerabilities of its own. So the balance of trade tells us how much a country is buying and selling abroad, but it doesn't tell us why that's happening or what the consequences are. For that, we need to zoom out and look at the bigger picture, the country's balance of payments. The balance of payments is a record of all economic transactions between one country and the rest of the world over a given period, again, usually a year. Think of it as the country's international checkbook. It tracks not just what a country buys and sells or trades, but where that money is coming in and going out through investment, debt, tourism, remittances, and financial transfers. Balance of payments is divided into two main sections. The current account includes imports and exports of goods and services, income from investments abroad like dividends or interest, and transfers like remittances, which is money sent home by workers abroad, foreign aid, or pensions. The capital account includes foreign direct investment, like when a company builds a factory in another country, portfolio investment, like buying stocks, bonds, or real estate abroad, and bank deposits, loans, and foreign exchange reserves. While you might sometimes see the capital account and the financial account listed separately, today the financial account is by far the larger and more significant of the two. For our purposes, and in most common discussions, they're often grouped together to represent the broad flow of investment capital. But here's the key thing to remember: the balance of payments always balances, at least on paper. That might sound confusing, especially if we just said that a country can run a trade deficit. But that's because any deficit in the current account, like importing more than you export, is offset by a surplus in the capital account, like attracting foreign investment or borrowing from abroad. So, when the United States runs a large trade deficit, that money comes back through other channels, like the purchase of U.S. stocks, bonds, or real estate. It's not that the money disappears, it just comes back through different channels. In that way, balance of payments doesn't tell us whether a country is winning or losing. Rather, it tells us how the money is flowing into and out of the economy, and what that says about the country's role in the global system. So now that we know what trade deficits and surpluses are and how they fit into the broader balance of payments, let's tackle the big question: do trade imbalances actually matter? The answer, like most things in international political economy, is it depends. Let's start with the concern. Critics of trade deficits argue that importing more than you export leads to serious problems, like the decline of domestic industries, job losses, or growing dependence on foreign producers. And in some cases, those concerns are real. For example, when a country runs a large and persistent trade deficit, it may lead to the erosion of manufacturing sectors, especially if imports outcompete domestic producers on price. This can have a ripple effect for jobs, wages, even national security if critical industries are lost. And as a result, critics sometimes worry that trade deficits make a country vulnerable to external debt or foreign ownership of key assets, since those deficits are often financed by selling government bonds or company shares to investors abroad. But that's only one side of the story. Many economists argue that trade deficits themselves aren't necessarily a bad thing, especially for wealthy countries with strong currencies like the United States. In fact, deficits can reflect economic strength. As we considered in our video on exchange rates, a strong dollar makes imports cheaper, which benefits consumers by giving them more choices at lower prices. High domestic demand can signal a healthy growing economy. And capital inflows, foreign investments, can help finance innovation, infrastructure, and public services. In this view, a trade deficit just means we're buying more stuff and other countries are investing that money back into us. It's not necessarily a crisis. And it's worth noting that trade surpluses aren't always a sign of success either. Countries like China or Germany run large surpluses, but that sometimes reflects underconsumption at home or over-reliance on exports for growth, which can create vulnerabilities of their own. So instead of thinking of trade deficits as always being bad and trade surpluses are always good, it's more helpful to ask, what's actually driving the imbalance? Is it short-term or structural? And what does it say about the country's place in the global economy? In short, trade balances can matter, but not always in the way that people commonly assume. So the next time you hear a politician say, "We have a massive trade deficit, we're losing," you'll know there's more to the story. Trade deficits and surpluses are important, but they don't tell us everything. Some reflect real structural problems, others reflect strong currencies, high demand, or the choices countries make about what to consume, what to produce, and how to grow. The balance of trade gives us a snapshot of how much a country imports and exports, but balance of payments tells us a fuller story: how the money moves in and out of a country, not just through trade, but through investment, debt, remittances, and financial flows. These flows don't just describe a country's economy, they tell us about its role in the global system, its relationships with other states, and the power it holds or lacks in shaping the rules of the international exchange. So when we look at trade data, we're not just crunching numbers, we're seeing the fingerprints of politics and power shaping the rules of global engagement.